Good morning, ladies and gentlemen. Well, the risk dial ended the week at plus 19, which is the best and highest score we've seen in quite a while. Still not full risk on. We have risk on the daily model, which counts for 20%. The monthly model is actually pretty damn sure to be in risk on as well, but at the beginning of next month. But the weekly model is also, and you can see here how it's improving by about 4 to 5 points per week now. So in 2 weeks' time, that should be in risk on as well. So there is a considerable risk that by the beginning of August we are in risk on in all time frames. And it's happening right at the level that one would have thought it should happen, which is the previous highs that we achieved in June. It looks like we're going to break them and go up to the all-time highs. Deviations is showing us that this is going to be a slow, steady grind up, I think, much like this period here throughout the whole of the late part of last year. It basically looks good. We have the middle line rising steadily. I think these lows around the 3,000 to 2954 level are now well supported. I don't think we are likely to see them again. Will we see little dips? Yes, for sure, but it's looking good. Whichever sector we look at, it's supported very close to where current price is. You have even the transports, which could make a move back up to the previous June highs. XLU, even though the bond market is doing absolutely nothing and has done nothing for the best part of 2 months now, are showing that prices could go higher. XLB is making new highs. Why would materials make new highs if the economy is forecast to be in a slump? No reason. This is to me a very bullish, a very bullish development that XLB can make new highs. Technology is taking a breather, which is absolutely normal after making new highs. It should underperform, because if you think about it logically, if the market is going to go towards the old highs, it has to be dragged up by XLF. Why should the financials lag so much if things are getting better? Maybe the market has discounted too much of bad news in XLF, and XLI and XLV, those should be the sectors that pull us up. Here we are in XLF. We have, it's starting to turn. This could always be your joker, your surprise. To me, being long of some call spreads in XLF is always a good idea when it dips towards the center line. And XLV is finally making the new highs that have been predicted for such a long time. That this sector is so strong, okay, we might have a couple of days of dips, is very, very good news. It has to be a leader, and it's the second biggest component after XLK. To me, this is very good news for the market in the longer term, and the fact that XLP is now making also new highs from June tells me that these jaws are going to open up, and with time we will be up here at the previous highs. The bond market is fast asleep. The Fed has managed to kill all volatility. The yield curve is not moving. There's absolutely nothing to see here. If we have a look at the German 5-year yield curve, which will be the most sensitive part, It's staying right in between the trend lines that I have. It's indicating absolutely that the market is fast asleep. If the yield curve in the States is asleep and the absolute level of interest rates is stuck at the, around the -60 to -70 area in Europe, that means that you're not going to get any bad news from the bond markets, and people will slowly be forced into risky assets because they just can't afford to stay in the to hide in the risk-off assets anymore, because they're not getting any kind of appreciation in their money if they keep it in the riskless, inverted commas, bonds. If you look at a weekly chart of TLT, look at the difference between open and close on the week. Almost nothing. Volatility has been absolutely eliminated from the bond market. That to me is very bullish for risk assets. If you can't get any appreciation on your money, or very little, and there is no reason to fear an immediate dip in equities, certainly not more than the normal 1%, 2% market retracement that you get at any time, you are almost forced to look out on the risk curve towards equities. This is probably the best news you have. If you have a lot of cash on the sidelines, where is that cash going to go? Into something that just doesn't move and has no reason to move, or is it going to go into something which has the potential for appreciation? I know which I think people will be buying in the next few weeks on any dip. If we look at the weather vane, the US dollar, we see that, to me, I think we are in a downtrend. Okay, I will not be surprised to see 93.14. I've been thinking for a long time, and I've been saying here, that if the Fed and all the other central banks want to increase risk taking, they have to lower the value of the dollar, because if you don't lower the value of the dollar, you have no reason to make people go along the risk curve. If it's safe to be in dollar assets because they're just appreciating, you might as well just go and buy US bonds, hide your money there, and you get the appreciation of the dollar, and also you get an interest rate pickup. You get yield. Well, the market cannot make it that easy for you. It cannot let you hide in US dollar assets forever, in fixed income assets, and that's precisely what's happening. Now you're beginning to get risk in holding US dollar fixed income, and that is the risk of depreciation. If we get to 93.14, people will start panicking a little bit, and on a daily basis it just looks to me like it's now opening these jaws, and all the risks are that it falls. Now that it's basically fallen through 96.50, which is such an important level, I think the risk is to 95.07, followed by several weeks later down to 93.14. 93.14 to me is a very pivotal level, and I think that is the direction of travel. This is a chart of the SPY over the FEZ, which is basically Europe, so States versus Europe. You can see the panic that we had first of all, you should see that the trend is very much one of appreciation of the S&Ps over Europe. And here you see the panic that we had during the COVID crisis. Don't forget, Europe is much less tech and much more basic industries. It's coming back, isn't it? it's going to test the 200-day trend line very soon. Europe has been outperforming the States for for several weeks now, and I think that we are getting to a pivotal level, a level that we will be around for maybe some time, and then break down towards the this very important 7 level, which to me was so pivotal in deciding to get out of most of Europe and buy states when it couldn't break below it. This goes back all the way to 2008 or even 2000. So we are, what this is saying is that the likelihood of basic industries doing well, and don't forget the US dollar here is an important component, as I've just shown you. This to me says that a lot of people are putting money to work into Europe also because they want not to be in the US dollar. That to me is ultimately bullish of all risk assets. And here we have XLF over SPY, we have XLV over SPY, and we have XLI over SPY. These three sectors, if tech is going to calm down and just trade in a range with, a few panics down, and then, they rip it higher, but basically it goes sideways, which I think is what should happen, these three sectors must go up. Certainly XLV, I picked the right one, is going towards this 33 level, and it would not surprise me if we get this much higher as well from here, towards 33.50. That is a large outperformance. But here I think XLF, and I really would not be short of XLF, because XLF is everything bad seems to be discounted in XLF, and we really could get a surprise move higher in it at any stage, simply because people say, well, things are not as bad as we thought. The defaults will not be as bad as we feared, and we could get some expansion. Here, this could easily move back up towards this line around 79, and really XLI, I think that it made a higher low than it did back in during May. I think that gives me some heart that we could see these upper levels here that we retraced to in when we were really panicking. That to me, the fact that XLI is now beginning to outperform, that XLV is outperforming, and that XLF has the potential to outperform, says that we are going to be in a slowly appreciating risk asset market. The correlation between the absolute level of the market and the level of volatility is also very important. The lower the volatility, the more VAR room people have to increase their risk positions, and I think it's happening. I think this is VXX. It's breaking down. I think it's pretty damn clear now that we will trade at least the 200-day moving average there at 27.60, but it would not surprise me to see over time and move all the way back down to where it came from, around this 10 level. This is just very long term, okay, that could take months, but the fact that we are now breaking down the previous reaction low, I think is very important, and we will continue to see that. To me, that indicates that over the course of a couple of weeks we will finally fill this gap and go up to 33.30 in SPX. That to me is the path of least resistance, 33.30 over the course of a couple of weeks. I think it's very clear that we, by what the Fed has done, by the way it has killed volatility in the bond market, it is killing volatility in the equity markets, increasing VAR that people can invest. the risk that they can take, the fact that the US dollar is weakening, are all factors which are forcing people to take on more risk. I think 29.54 unfortunately now will not be seen for a very, very long time, if at all. The risk is definitely, I think, that we start going towards all-time highs. Volatility at the moment is extremely, extremely important, I think. The less volatility there is, the more the huge cash mountain which has been parked by institutions will have to be invested drip, drip, drip. We are already below 26.81 on a close last Friday. If we can just close below 22.72, that will give me much more certainty that the uptrend is immediate. On a daily basis, this is the weekly chart and this is the daily chart. On a daily basis, it has closed below the 200-day moving average for a very, very long time. The moving average is still upward sloping, but and this is why I'm not forecasting a complete collapse of volatility and a spiking bull market in equities, in risk in general. I think that risk is going to be drip fed into the market, and that we are going to see slowly appreciating prices at the classic buy the dip market. This could easily now go down towards the 22.77 level and probably stop there for a while, retrace back up to 28, and then go finally break it sometime in the autumn. That is what I'm looking at. Volatility to me is so important, because any kind of spike in volatility, the room for people to add to their risk position is diminished, and therefore I really want to see this below 22.72. If that happens, I'll be much more comfortable with being probably leveraged long of risk assets. The next question is, should volatility be going down? And if we have a look at the ranges for the past 3 days, we can see a real compression, can't we? While the moving averages are all deploying higher, we have every single moving average is now where it should be, i.e. the shortest at the top and the longest at the bottom. They're all trending up. Yes, we have formidable resistance here at 32.33 in cash SPX. We have not broken it, but we are doing everything right. We are just slowly heading higher. We are allowing these Bollinger Bands to follow the market up and to open up and allow it higher. So that means we're not overbought. What do I forecast? I forecast a period like here, slowly going upwards, and what is the terminal value that we're looking for here? We're looking for 33.25. That is the level that I would not be surprised to see it trade in the course of next couple of weeks, and then probably have a swoon back to this level around the 32.30 level. It seems that the market basically takes out all levels, goes to the next resistance level, comes back to the old resistance level, meanders, goes back up, breaks. That is a pattern which indicates that dips are being bought and indicates the volatility is headed lower, and therefore VAR can be increased by market players. To me, this is all the way it should be, and it's bullish. On a weekly chart, there seems to be very little to fear here. The moving averages are now very supportive around the 30.30 level. 29.54 I don't think we can see. I think Is it going to take 2, 3, 4 weeks to get up to 33, 37? Who cares? I think it's going to be one of these periods with mostly green candles, but also some very small red candles. Exactly what the market needs to basically get it through the summer and set it up bullishly for the end of year. Could this be forecasting that at some stage we get a vaccine? It could be, but I certainly think that it's immediately in no way bearish, and that you have to start increasing risk. Everything is telling you the same. The US dollar, the fact that volatility is trending lower, the fact that realized volatility is lower, all these are factors which tell you that the downside is very, very well protected. And finally, Europe. What did I say? Very tough resistance around the 12,800. It has taken it out. I think it's now almost sure that we trade 13,440 in the DAX, and at some stage we will be here around the 3,500 level in the SPX, with a final resistance really around the 3,645. The DAX is definitely leading the stocks. That's not in question. Much prefer to be in DAX than in stocks. But if that is also telling, because the DAX is so industrial, so old world, that tells me that the likelihood of XLF and XLI and XLV outperforming SPY and carrying it higher are better than even. So if I like DAX, I have to like those sectors in the States as well, because they have a following, they have a wind in their back with a lower dollar. I think it's all falling into place to see 33 in the SPX, to see 13,400 in the DAX, and to see about close to 3,500. Let's call it here. What's that? 3480, something like that in the SPX. I'm not going to show you the chart of Nikkei, but that also is telling me much the same story. In fact, every chart I look at, none of them are contradicting the basic story of lower volatility, higher grinding prices, and a cash pile which was going to have to be invested at higher levels. The market is unlikely to let people invest it at lower levels and then rip higher, is it? That's all there is to it. I think it's as simple as that. You buy the micro dip and you enjoy your ride higher. Thank you very much indeed, and tweet you on Monday.